this lesson, we basically want to proceed our discussion on share-based payment. That is International Financial Reporting Standard 2. We've already looked at the introduction, the first type of share-based payment transaction, which has to do with equity-settled share-based payment transaction. We've looked at that thoroughly, how to account for equity-settled share-based payment transaction, how to recognize it, how to even measure and recognize it in the books of an entity. We've also solved a series of practical questions on each of the principles that equity-settled share-based payment presented to us. We've established our understanding in equity-settled share-based payment. In this lesson, our focus is going to be on the second type of share-based payment transaction or share-based payment, and this has to do with the cash-settled share-based payment, which we lay emphasis on in our first video in our first lesson, that we basically have two types, the equity-settled and the cash-settled. But there are some times where an entity is faced with a third type, which has to do with when the entity or the employee is allowed or is having the choice to choose between the equity-settled or the cash-settled share-based payment transaction. In this lesson, our focus, like indicated earlier on, will be on the cash, and then in our subsequent lessons, we will look at situations where the entity is presented with the choice to choose between the equity or the cash settled share-based payment transaction. So our focus is going to be on the cash settled share-based payment. Share-based payment transaction. Now, as I indicated in our previous lesson, that when we talk about cash-settled share-based payment transaction, it is where an entity receives goods and services, and the price of those goods and services are determined based on the share price of the entity or based on the price of the equity instrument of the entity. So the entity has received goods from a supplier or has received services from an employee, and the price of those goods are determined based on the share price of the entity. In this case, the entity is not issuing equity instruments, neither is the entity issuing share option, just that the price of the goods and services are determined based on the equity price of the entity. So please know the difference. So here, the recognition here is that the entity is going to recognize an expense or an asset, as we indicated in the first video. If the entity consumes the goods or services, becomes an expense. But if those goods and services will remain in the business for quite a while before it will be consumed, it is an asset. So when it comes to recognition under the cash settled, is basically redebiting expenses or an asset, and then we are going to credit what we call liability. Credit liability. So here, there is nothing like equity over here. Under the cash settled is either we are going to debit expenses and then credit liability under the cash settled share-based payment transaction. A typical practical example of the cash-settled share-based payment transaction has to do with shares appreciation rights. Now, how do we value this? Just as we did under the equity-settled share-based payment, all those principles hold over here. But just that subsequently, the liability, the value of the liability must be remeasured at the end of every reporting period. Not like the equity settled share-based payment, where subsequently we do not measure the equity component of the transaction. We don't measure the equity subsequently. When it comes to the cash settled share-based payment transaction, we have to always remeasure the liability component to check whether there is an increase or there's a decrease in our liability component. The approach of whether it's going to have a vesting period or it's going to vest is the same thing. So if you not understand or you've not watched the videos on the explanations on vest, it does not vest, vesting period, grant date, You can equally go and watch the lesson on that on the channel. Once again, remember that the value that we use here is not going to be the grand date value as we did under the equity settle. Here, we are going to use the fair value at the dates, at the reporting date of the entity, the fair value of the goods and services, the reporting date of the entity. That is what we are going to, not the grand date tag when it comes to the cash-settled share-based payment transaction. This one is a bit simpler as compared to the equity settled share-based payment transaction. So the last thing we will look at under the cash-settled, here we are going to solve some 2 questions to augment our understanding. There are some times where after the vesting date or when the transaction has vested, the liability or the transaction will be exercised by the employee or maybe the supplier. Okay, so that's liability or the transaction, the shares appreciation right will be exercised. And anytime the shares appreciation right is being exercised, it will be exercised at the intrinsic value. The intrinsic value will be exercised at the intrinsic value. Now remember that there will be difference between the fair value of the equity instrument and then the intrinsic value. There will be a difference between that. So those, remember that some of the employees may exercise it, whilst others may continue to hold the share appreciation right in the entity. So anytime an employee is exercising each shares appreciation right, the value to use for the exercise price is the intrinsic value. Any difference between the intrinsic value and then the fair value of their share appreciation right will be an item to be taken to the profit or loss account. Will be an item to be taken to the profit or loss account. So we will take a practical question on this one and then we see how it goes. So without wasting my time, let's take our first question to establish this one. Then when we are done, we take the next question to establish when it is what? It is exercised. When it is exercised. Alright, so as the question on the screen, let's read. An entity has a reporting date of 31st December. So the reporting date of the entity is 31st December each year. Now on 1st January 2021, the entity grants 100 share appreciation rights. So immediately you see shares appreciation rights, then you should know that it's a cash settled share-based payment. So to each of its 300 employees, so the 100 share appreciation right is being granted to each of its 300 employees. Now let's look at on the condition that they continue to work for the entity until 31st of December 2023. So here the contract date is 2021, 1st January to 2023. So like I indicated, everything about vesting, as we have indicated under the equity settle, also holds in this particular transaction. So let's see what goes on. They said on the condition that they will work, we've established that during 2021, 20 employees leave. So this, you have to take note of those who actually leave and those who are expected to leave in the subsequent 2 years. So 20 employees are leaving in 2021, and entity estimates a further 20 leaving in 2022 and then 2023 based on the question on the screen. Then during 2022, 10 employees leave, and then they expect that a further 20 will leave in 2023. During 2023, 10 employees actually leave. We've established that the difference between these when we're looking at the equity settled share-based payment. But once again, I will look at it. If you look at the question very carefully, they didn't give us any grand date price. But if you go down small, they said the fair value of the shares appreciation right has been given to us. So in 2021 is $10, 2022 is $12, and 2023 is what? Is $15. Calculate the expense for each of the 3 years of the scheme and then the liability that the entity is supposed to account for. So here, remember that the entity is not going to account for anything like equity. It is going to be an expense or an asset and then also a liability. So let's take it one by one as we did under the equity settle. So here we are going to look at 2021. And how many employees are we looking at? We are looking at 300 employees. Now, how many of the employees actually leave in 2021? We were told that in 2021, 20 employees actually leave. And then they expect that 40 will leave in 2022 and 2023. So here we are going to less 20 for 2022 and then 20 for 2023. Now we multiply this by the number of shares appreciation right, which is in the question is 100. Then the price of the share appreciation right, the fair value of the share appreciation right after 2021 is 10. Is $10. So we multiply all these by 1/3 because the vesting period is 3 years. So we multiply everything by 1/3. Once we've done this, we should get the expense and the liability. We should get the expense and liability all in dollars. All in dollars. So let's do the calculation. So this is given as 60 minus. So we are going to get 240 times 100 times 10. 240 times 100 times 10. All these multiply by 1 divided by 3, and that's given us 80,000. So you recognize 80,000 expense in 2021 and 80,000 liability in 2022. In 2022, as simple as that. Now let's go to 2022. 2022. Now in 2022, we have still 300 employees. Remember that the actual that leave in 2021 will be less over here. Then we go to 2022 and see what is happening. 2022, they said 10 employees actually leave. So the actual that leave in 2022 is 10. And then a further 20 is expected to leave in 2023. This we multiply by the same 100 shares appreciation rights, but now the fair value must change. We have to go and look for the fair value as at this date. That has to do with cash settled. Every time we have to go and look at the new fair value of the shares appreciation right. In the question, the new value is $12. So we multiply this by 12. Remember, you have to multiply this by 2/3, looking at the vesting period. The vesting period. So in this case, we are going to have 250 times 100 times 12. All this will multiply by 2/3, and that's giving us 200,000. Remember, this 200,000 is our liability. It's our liability. The 200,000 is a liability. So we take the year 1 liability from year 2's liability. That is the closing minus the opening to get the expense for the period. So the expense here is going to be $120,000 for year 2. We can quickly look at year 3, which has to be 2023. Now in 2023, still employees of 300. How many actually leave in year 1 is 20. How many actually left in year 2 is 10. And then we go to the actual that's left in 2023, and they said 10 employees left in 2023, so 10 over here. Then we multiply by the same 100 share appreciation rights, and then the value now is $15. $15. We can choose not to multiply this because it's going to give us 1, because 3/3 is going to give us 1. So in this case, we have 260 times 100 times 15. 260 times 100 times 16. It is given at $390,000. $390,000. For us to get our expenses is the closing of 2023 liability minus the opening of 2023, which is 200. So this minus this will give us $190,000. So this is what we recognize in year 1 as your expense, year 2, year 3, and this will be your liabilities in the respective years. This is as simple as the cash settled share-based payment, which has to do with share appreciation rights. Look at the valuations. If you look at the way we treat the employees, is the same as we did under the market condition or non-market condition under the equity settled share-based payment. Nothing has changed. It's the same thing. So once you understand that, you can apply it over here. Now let's look at the question where after the vesting period, the share appreciation right will be exercised by the employees. And let's look at how those principles will be tackled in this particular question. Okay, so the question is on the screen. Let's go through. On 1st January 2014, RONAS granted 200 share appreciation rights to each of its 500 employees on the condition that they continue to work for the entity for 2 years. So yeah, they are going to work for 2 years. They are giving each of the 500 employees 200 share appreciation rights. On 1st of January 2014, that's the contract, the entity expects that 25 of those employees will leave each year. Look at the statement. 25 of those employees will leave each year. 25 of those employees will leave each year. Now, during 2024, 20 employees leave. Then, the entity expects that the same number will leave in the second year. So, take note, during 2024, 20 employees leave. So, 1st January, the entity expects, the expectation is that 25. Those employees will leave each year. Now, they said during 2014, 20 employees actually was left. And then those that they expect to leave is the second year is the same 20. Now, 2015, 20 employees actually leave. We are just looking at 2 years. Now, the share appreciation rights vest on December 1st, 2015, and can be exercised during 2016 and 2017. You see, so the employees can exercise the share appreciation rights in 2016 and 2017. Now let's look at what is happening on 31st December 2016. 257 employees of the employees are eligible to exercise their share appreciation rights at full. So we will look at that. If you look at the question, they have given it the fair value of the share appreciation rights and their respective intrinsic value. At the date that all the employees will exercise their share appreciation rights, the intrinsic value and then the fair value of the share appreciation rights are the same. And that is what we are basically looking at or seeing in this question. You can see that the last day, which is 2017, the fair value of the share appreciation right and then the intrinsic value is $10. Then the remaining eligible employees exercise their share appreciation rights in full on 31st December 2017. So let's look at how we are going to go by this question. All right, so first things first, before we go to the date that the share appreciation right vest, we first have to establish the expense and liabilities for the 2 period before we can go to how to compute for when the employees are exercising their rights. So first thing, we are looking at 2014, and we're told that this share appreciation is for 500 employees. And in 2014, what is happening there? In 2014, what is happening there? They said during 2014, 20 employees leave, and the entity expects that the same number will leave in the second year. So we are looking at just 2 years. So 20 minus 20, and they are being granted how many share appreciation rights? They are being granted in the question 200 share appreciation rights. So we multiply this by 200 share appreciation rights. And what's the price as at 2014? The price of the share appreciation right as at 2014, that is $5. $5. Remember, we are going to multiply this by 1/2 because the vesting period is 2 years. So here we can recognize our expenses, and then we can now recognize our liability as well. We can recognize our expense and liability. So they are all in dollars. So let's look at the first computation. The first computation is going to give us the 500,000 minus 20 minus 20. That's going to 460 times 200 times 5. We multiply this by 1/2, and that's giving us 230,000 for both expenses and then liabilities. Okay. Then we can quickly look at the second year, which is 2015. 2015. So in 2015, we are still dealing with 500 employees. How many actually left in year 1 is 20. How many actually left in year 2? From the question, 24 employees left in year 2, 24. So this is going to give us, multiply by 200. What's the share price now at the end of year 2? At the end of year 2, the share price now is $7. $7. So all these will multiply by 2/2. over 2. So this is going to be 500 minus 20 minus 24, and the whole thing is giving us 4, 5, 6. There's a reason for this because of the number of appreciation that is going to be exercised by each of the employees. You can see that they gave a different employees to them. Okay, so the 4, 5, 6 multiplied by 200 multiplied by 7, and that's giving us 638,400. So we take this from this to get the expense for year 2. So minus 230,000. That's giving us $408,400. So that is it for the 2 years. Now you have to learn how to do or calculate for the exercise. They said in 2016 the 257 employees, that's the question, 257 employees are exercising their rights in 2016, and then in 2017 the rest. So you see now we only have 4, 5, 6 employees, so take note of that. So if you take the 4, 5, 6 employees minus the 275, we are getting 199. So 257 is for 2016, and then 199 will exercise VS in 2017. So please take note of that. All the employees that are left will not exercise their right at the same time. 257 is exercising their right in 2016, and then 199 of the employees are exercising their rights at 2017. So let's look at 2016. In 2016, what is our balance of liability brought forward? So balance brought forward in 2017, and that is going to be, let's do that over here. That is going to be the 638,400. Now, what is the exercise price? The exercise price in this question is going to be the 257 employees multiplied by the share option given to them 200 multiplied by the intrinsic value of 2016. Remember that they will exercise this right at the intrinsic value. And in this case, it's going to be $7. The intrinsic value in 2016 is what? Is $7. If you do this, we are going to get 257 times 200 times 7, and that's going to give us 359,800. Since this one are exercising their right, we need to left it from the remaining liability. Now, what is the closing balance of 2016? The 199 still remains. The 199 still remains. Okay, the 199 still remains, and they will continue to what? Fair value their share appreciation rights. Only this one have exercised their right. So let's look at that. Let's leave some small space for some computation. So the closing balance, so the balance CD is going to be the 199 employees multiplied by 200 multiplied by the fair value of the share appreciation rights in 2016, and it was given to us in the question to be $8. So 199 employees which are remaining times their share appreciation right times the price of what? 8, and this giving us 318,400. So any difference between this figure, and this figure will go to our profit or loss account. So let's see, is there any difference? So this plus 359,800, then this minus whatever we are paying. So if you can see, what we are paying is more than what we have there. So it will go to 39,800. 39,800 will go to profit or loss account as well as an expense. Will go to profit or loss account. 39,800. This value here will go to our profit or loss account. $39,800. Okay, now let's go to 2017. 2017, our balance brought forward will be this one, the balance sheet in 2016. So it's going to be the 318,400. Now, in 2017, the question indicated that the 199 employees are also exercising their share appreciation rights. For that matter, we are going to take everything away, which is going to be the 199 multiplied by the 200 shares multiplied by the intrinsic value, because they are exercising, so they have to exercise at the intrinsic value. And if you look at the last date that all the employees are exercising their rights, the intrinsic value and then the fair value of the share application rights are the same. They are all $10. So here the intrinsic value here is $10. Now let's do the computation to see what we are getting, if it should be equal to this. So 199 times 200 times 10, and that's given a 398,000. 398,000. Now, any difference between this figure must go to profit or loss account, because we are closing everything. We are closing everything. Remember, this one is being exercised. It's being exercised. So any difference between this and this must go to 318,400. So if you are getting 79,600, this 79,600 must go to our profit or loss account. Must go to our profit or loss account. So this is how to, exercise the share appreciation right. So take note of how we deal with cash settled share-based payment. If there is going to be any exercise of the share appreciation right, we use the implicit value, and don't forget about how the remaining employees and then the existing employees are able to exercise their share appreciation right. It's not always the case that all of the employees will exercise their rights at the same time. Some will do theirs first and others will do theirs first. Those that will continue to hold their rights must be measured at the fair value of the share appreciation right. And those that have exercised their rights, they have to measure it at the intrinsic value. Under normal circumstances, they should always provide you with the intrinsic value. So please take note of that. So that is it for cash settled share-based payment. In our next lesson, we are going to look at when the entity is having the choice to choose between either equity settled or the cash settled, and how the entity will account for such transactions when the entity is presented with those choices. Thank you.